It is another Thank God Friday edition of Money Moves on this last Friday in the month of February. I am Melissa Enoch here at the FMDQ studios in Lagos.
And I am Grace Agbarago. It's the 27th of February. We hope you had a great week so far.
All right, let's tee off with your news now for this Friday. The Reserve Bank of Zimbabwe today announced new measures to streamline transactions and curb fraud. Cash withdrawal fees are set at 2%, POS charges at 15%, while balance inquiry and cash deposit fees are removed. Mobile operators must audit accounts and deactivate fraudulent ones. The primary policy rate remains 35%, with foreign exchange retention at 70%. Small-scale miners must now surrender 10% of foreign exchange earnings. Let's hear more from Dr. John Musha Yevanu, Governor of Reserve Bank of Zimbabwe.
We are meeting at a time when the situation on the ground is looking good. We have managed to reduce annual inflation from a high of 95.8% in July 2025 to single-digit levels of 4.1% in January, and only yesterday we got the February inflation figures at 3.8%. So we are now firmly in single-digit territory and in line with the SADC benchmarks of 3 to 7%. So for the first time in many, many years, we can stand and say we are operating in line with the SADC benchmarks. We have also managed to grow reserves from 0.18 months when I took over in April 2024 to 1.5 months of import cover as at 31 December 2025. We also, as we promised in my maiden monetary policy statement, have ensured that at any one time, reserve money is fully backed by reserves. And we have also managed to contain growth at inflation neutral levels. As regards foreign currency, we have continued to generate significant inflows of forex. Last year we did in excess of $16 billion US dollars, and arising from that, we are seeing a situation where there are no outstanding invoices to be paid when it comes to payments.
MTN Nigeria has posted revenue of 5.2 trillion naira and profit after tax of 1.11 trillion naira for the year ended 31 December 2025, marking a strong turnaround from 2024. Basic earnings per share rose to 53.07 naira, and the board proposed a final dividend of 15 naira per share, taking total dividends to 20 naira per share. Subscribers grew to 87.3 million. EBITDA margin rose to 0.7%, and capital expenditure exceeded 1 trillion naira to support the network expansion. The company attributed the growth to tariff adjustments, operational efficiencies, and strong revenue mix, positioning it for sustained 2026 performance. Still on earnings news, Discovery Bank swung into profit in the 6 months to December, reporting earnings of between 210 million rand and 230 million rand from a loss of 145 million rand a year earlier. The update pushed the group's share price to a 52-week high, with the stock up more than 8% on the day. Discovery said normalized headline earnings per share is expected to rise by 24 to 29%, while headline earnings are forecast to grow by 27 to 32%. The bank also reported strong client growth, adding about 1,500 customers per day by period end. In the meantime, the Bank of Uganda today highlights two of its flagship initiatives, the Agricultural Credit Facility and the Small Business Recovery Fund, aimed at supporting farmers and reviving small businesses across the country. From boosting agriculture to empowering entrepreneurs, the Bank of Uganda is playing a pivotal role in strengthening the nation's economy and improving the lives of everyday Ugandans. Let's listen.
So the Agricultural Credit Facility was a government initiative that started way back in 2009. The idea was to finance agricultural enterprises that were finding it difficult to access affordable financing because the commercial banks or the supervised financial institutions were regarding this as a risky venture which is affected by weather, floods, and everything. And so they were not willing to give financing. And whenever they gave, it was very expensive.
Yes.
So the government thought it fit to put in money to support agriculture. Initially, government started with 30 billion. The way it operates is that it is a partnership with supervised financial institutions. So the government puts in half of the money, and the commercial banks and other institutions put the matching fund,
Yes.
the other half. So we started with a total of 60 billion way back in 2009. And that's how it operates. Cheap credit, affordable for farmers, and the idea was to modernize and commercialize agriculture as well.
Yes.
And as we discuss further, this also ensures our food security. And food security also may mean, not all the time, but it means a lot to the political stability.
Yes.
Hungry people are very angry.
That is very true.
So that's the origin of the Agricultural Credit Facility.
Okay.
Yes. So the Agricultural Credit Facility was
In other news, Stanbic Bank Ghana Limited, together with the Standard Bank of South Africa Limited, has arranged a $205 million senior secured term loan and revolving credit facilities for Engineers and Planners Company Limited, Ghana's largest indigenous mining contractor. The 5-year facility will support E&P's long-term mining operations with Goldfields Ghana Limited, strengthening local capacity in a sector central to Ghana's economic growth. EcoBank Ghana PLC and Absa Bank Ghana joined as lending partners. In Rwanda, the National Bank of Rwanda has successfully completed a 5-month proof of concept for a potential central bank digital currency CBDC, the eFranc Rwandais, confirming that a retail CBDC is technically feasible. The POC tested secure instant payments, offline transactions, and USSD functionality for feature phones, enhancing financial inclusion and system reliance. No decision has been made on national launch, with a 12-month pilot with real users next. The exercise involved banks, fintechs, and public institutions advancing Rwanda's digital financial transformation. At the 2026 Standard Bank African Markets Conference, experts discussed the crucial role of domestic investors and commercial banks in financing Africa's infrastructural development. The panel highlighted how local capital and banking sectors can drive sustainable projects across the continent, addressing transport, energy, and urban development needs. Let's listen.
The whole funding dynamic has changed. We speak about inbound and outbound funding. South Africa was always regarded as an inbound country. In other words, the international banks, predominantly the banks in Europe, UK, and America, were funding projects in South Africa. This whole dynamic has changed. We see now South Africa as probably the most prominent and effective outbound market into Africa. So I did a quick analysis, and if you look at the top 10 banks in Africa, positions 1, 3, 5, 6, and 7 are filled by the South African banks. Standard Bank alone has 21 operations in Africa. You consider, if you exclude North Africa, there's 48 countries. They're in almost half of the countries in Africa. Similarly, ABSA has a very big footprint, and so does the other Southern African banks. So we've realized that the funding into Africa is not going to come from where we believed it used to be, or where it used to be. It's now going to come much more from South Africa. Also, if we talk about the asset managers, the 3 largest asset managers are all based in South Africa. But not just by assets invested, in terms of actual investment in Africa. So one of them, for example, 91, has 3 dedicated African funds. We know that AIM has a very significant Africa fund, as does Sanlam. Sanlam is the largest insurer on the continent. So we've changed our whole thinking, and we're far more focused now on the financial institutions present in South Africa and how we can support them with funding projects on the African continent. This also extends to the DFIs, and once again, I will use South Africa as an example. I'm a bit biased, but the DVSA has a footprint of 18 countries in Africa, sub-Saharan Africa, and the IDC is present in 11. So there's a lot we can do from South Africa to support infrastructure investment in the rest of the continent.
Finally, on News Now today, South Africa has launched the WIT South Africa Hydrogen Localization Investment Facility, WIT-SALI, a major step in building the country's hydrogen industry. Unveiled during a sword-turning ceremony, the facility aims to drive innovation, create jobs, and support a sustainable economy. Equipped with a 110 kilowatt electrolyzer, 200 kilograms hydrogen storage, and 200 kilowatt clean power system, it will also train engineers, scientists, and technicians to lead South Africa's hydrogen future. I am Melissa Enoch, and that's it for News Now this Friday. The show returns shortly with Grace at the FMDQ ticker tape room, giving us our market updates.
Hello, I'm NJ. I'm so happy to talk to you today about what I have coming up next month. On March 16 and 17, guess what? I will be attending the Southern African Oil and Gas Conference in Cape Town at the Central City. This is being organized by the South Africa Oil and Gas Alliance, a platform that has been strong advocates for oil and gas development, not just in South Africa, but across Southern Africa. They've led various initiatives about de-risking South Africa, encouraging investments into Mozambique, Namibia, and even Angola. But here's what's even better. This year, we stand to have discussions around deals, expanding oil and gas development in South Africa, unlocking new opportunities, but also creating that badly needed enabling environment to ramp up investment and drive into not just South Africa, but the region. Our region has been booming. You've seen massive discoveries around the Orange Basin in Namibia, massive discoveries in Mozambique. But even guess what? It's starting to move in Mozambique again. Total Energies is back. That project is ongoing. Rovuma LNG with Exxon, it's kicking off. But guess what? Even in South Africa, we're seeing Total Energies still seeing offshore the Orange Basin and moving. Eco Atlantic, we are not stopping. It means that at this conference, we are going to not just discuss strategies, but also create opportunities for local service providers to be great active participants in the region. Deals to be signed that empower people and create jobs and improve local content and develop opportunities. But even more better, being unapologetic about oil and gas. And you know, I'm not gonna be apologizing for oil and gas. We're gonna go full on drill, baby drill on March 16 and March 17. We're going to stick with a strong Southern African narrative that says that we're gonna unlock the region, open it up for new drilling, drive new energy, and do it sustainably. But guess what? We are going to push for more investment in this region. Because you know why? When we do that, everyday people benefit. Energy companies provide the gas that we need to build LPG plants, urea, ammonia, NPK, fertilizer plants to drive up industrialization in this region. South Africa is still going to continue being that industrialized, the most industrialized nation in the African continent. That is going to drive growth around the 300 million in SADC. Join us at this conference, and I will be supporting our brothers and sisters from Sauga because they're just doing exactly what the industry is at this time. Thank you, and I look forward to seeing you there. And don't you forget, if you forget one thing, remember, drill, baby, drill, all the way. Thank you so much, and God bless you.
Welcome back to Money Moves. Let's now go over to Grace for updates on how the markets closed trading on this last week in the month of February. Hello there again, Grace.
Thank you, Melissa. Let's now track how the markets wrapped up trading across the continent for the month of February, beginning with equities as usual. The NGX All-Share Index declined by 0.38%, while West Africa's BROVM added 0.21% to 417.21. The Nairobi Securities Exchange rose 0.21% to 216.08. In the South, the Johannesburg Stock Exchange gained 1.26% and Zimbabwe ZSE slipped 0.24% to 359.11. In North Africa, Morocco's MASI dropped 0.61% to 18,257.09. On the currency front, the Rand eased 0.19% to 15.97 against the US dollar. The Egyptian pound was steady at 47.95. The CFA franc gained 0.38% to 555.61. The Kenyan shilling held at 129. The Moroccan dirham rose 0.20% to 9.17, and the naira strengthened 0.57% to 1,359 naira 94 kobo as at 13:55 GMT. Let's switch into the commodities data deck, beginning with energy prices. Brent crude jumped 3.04% to $72.90. US WTI climbed 3.59% to $67.54. Natural gas rose 1.91% to $2.88, and Arabian gasoline added 1.24% to $2.05 as at 13:40 GMT. Now, finally, to soft prices. Cocoa fell 4.08% to $2,938. Coffee slipped 0.97%. Cotton eased 0.18% to $65.24. Palm oil rose 0.69%, and sugar dropped 0.72% to $13.85 as at 13:46 GMT. And that's our Money Moves markets today. Back to you, Melissa.
Grace, thank you very much for those market updates. And that's it on today's edition of Money Moves. From all of us here at the FMDQ studios, we say thank you very much for watching and do have a splendid weekend. We'll see you next month.